Welcome to the deep dive. Today, we're looking at a company you probably associate with, a highly specific and honestly somewhat mundane administrative tasks.
Right, just signing a PDF.
Exactly, just e-signatures. But underneath that simple interface, Docusign has been quietly capturing the invisible nervous system of the global economy.
Which is to say contracts and agreements.
Yeah, and they're using them to build this massive, really data-hungry AI powerhouse. So a huge welcome to you, our dedicated listener. You are the learner.
Always glad to have you here.
So today is Wednesday, March 18th, 2026. And just yesterday, Docusign dropped its Q4 2026 earnings report.
Fresh off the press.
Totally. So we've compiled our sources for this. We're looking at the official financial press release via Court and the full earnings call transcript via MarketBeat.
Lots of good data in there.
Tons. And our mission today is really to explore the mechanics of this transformation. How a company that became a verb for signing a document became this AI juggernaut. Okay, let's unpack this.
And, for you listening, whether you are prepping for a major tech strategy meeting or evaluating enterprise software architectures, this really matters.
Oh, absolutely.
Or even if you just want a better grip on where the future of work is actually heading, agreements are the structural scaffolding of literally every major transaction.
Yeah, like buying a house.
Right, buying a house, taking a new job, or, closing a massive corporate merger.
It's everywhere.
It is. So understanding how AI is fundamentally rewiring this scaffolding, well, it gives you a massive analytical advantage. You're essentially getting a look under the hood of the modern enterprise.
So to really understand how they are rewiring that system, we first need to look at the raw financial fuel that's driving the change.
The money.
The money, because the headline numbers from this earnings call, they show a significant influx of capital that gives them a really unique strategic runway.
It really does.
In Q4 alone, revenue hit $837 million.
Which is why.
Yeah, it's an 8% year-over-year jump, and total fiscal year revenue actually crossed $3.2 billion.
And they also hit two really critical milestones that signal a highly mature software business.
Okay, what were they?
First, billings topped $1 billion for the very first time in a single quarter.
Wow. $1 billion in one quarter.
Yeah. And second, which is perhaps more importantly, the company generated over $1 billion in free cash flow for the full year.
That is a lot of cash.
Right. To put that in perspective, that is a 33% free cash flow margin.
Okay, let's define that free cash flow margin for a second, just to make sure we're all on the same page.
Sure, yeah.
That essentially means that for every dollar of revenue that comes through the door, Docusign has 33 cents of pure, unencumbered cash left over, after paying all their operating expenses and salaries and capital expenditures.
That is correct.
Yeah.
It is cash they could basically deploy however they see fit. And we are actually seeing exactly how they intend to deploy it. In Q4, Docusign executed a record $269 million in stock buybacks.
Oh, wow.
Yeah, and they also just announced a $2 billion increase to their repurchase program.
Wait, $2 billion?
$2 billion, bringing their total capital allocated for buying back their own stock to $2.6 billion.
That is just a massive deployment of capital, but the financials are kind of only half the story, right? The board of directors is the other half.
Yeah, definitely.
Because they are actively reassembling their leadership brain trust for this specific AI transition. They recently brought on Brian Roberts.
Right, from Andreessen Horowitz.
Exactly. He is currently a general partner at that venture capital firm, but his background is deeply operational. He was previously the CFO of Splunk and Lyft.
Two very heavy-hitting tech companies.
Yeah, and now he spends his time advising companies specifically on building AI-native applications.
And bringing someone with his specific combination of, enterprise CFO experience and AI investment perspective to the board, it's a very clear signal.
Yeah, it's not subtle at all.
Not at all. They are no longer positioning themselves as a simple utility application. They're really positioning themselves as an AI platform.
And that pivot to becoming a platform, it brings us to a major structural change they announced on this call.
The metric shift.
Yeah. Docusign is completely abandoning billings as a top-line reporting metric going forward.
Which is a big deal in the SaaS world.
It is. Instead, they're shifting entirely to reporting on annual recurring revenue, or ARR, which just hit $3.3 billion.
A huge number.
Right. Now, my immediate skeptical reaction as, someone looking at the market is to wonder if this is kind of an accounting trick.
Sure, that makes sense.
Like, if a software company suddenly changes the scoreboard they use to report their success, it often makes me wonder, are they trying to mask fluctuating sales or hide customer churn?
It's a completely natural reaction to be skeptical of a metric shift like that. But if we look at the accounting mechanics of a software as a service business, this change actually provides more transparency into their new model, not less.
Oh, how so?
Well, billings represents the actual invoices sent out. So if an enterprise customer signs a 3-year, $3 million contract and pays entirely upfront, billings for that quarter spikes by $3 million.
Right, which looks amazing on paper for that quarter.
Exactly. But that massive spike masks the reality of whether the customer is actually using the software month to month.
Ah, I see.
ARR, or annual recurring revenue, smooths that all out. It recognizes that $3 million contract as $1 million of recurring value per year.
Okay, so to build on an analogy here, sticking with billings is kind of like a gym measuring its success entirely by how many people buy an annual membership on January 1st as a New Year's resolution.
That is a perfect way to look at it.
Right, because it looks fantastic on paper for that 1 month, but it tells you absolutely nothing about who is actually showing up to use the treadmills in March.
Exactly.
ARR forces the business to prove value every single month. It aligns the financial metric with the actual ongoing software consumption.
That is the exact mechanical difference. And this shift to ARR is fundamentally tied to the rollout of their new AI platform.
Because the platform changes everything.
Yeah, it changes how customers buy, consume, and renew their software. So they need a metric that tracks ongoing usage, not just lump sum software licenses.
Which brings us to the core product architecture driving this entire deep dive. This platform is called IAM.
Intelligent Agreement Management.
Right. And we really have to separate the legacy concept of e-signature from IAM. They are not the same thing.
Not even close. IAM is an AI-native end-to-end platform.
Yeah.
A traditional e-signature is just a static event.
Yeah.
You upload a PDF, you place a digital signature box, and hit send. The document is essentially dead data.
Right. It just sits there on a hard drive somewhere.
Exactly.
Yeah.
But IAM changes the entire life cycle of that data. Pre-signature, it helps you prepare the document by using AI to summarize past terms and pull data directly from your CRM.
Oh, wow.
Yeah. And then during negotiation, it uses AI-assisted reviews to check the contract's clauses against your company's approved legal playbooks.
That is incredibly useful.
And then post-signature, it actually extracts the data so you know what obligations you just committed to. It turns a static PDF into a living system of action.
And the financial trajectory of this new architecture is incredibly steep. I mean, they launched IAM just 18 months ago.
Barely any time at all in the enterprise world.
Right. And today, it is already generating over $350 million in annual recurring revenue.
Which is massive growth.
It's crazy. Last year, IAM was just 2.3% of their total ARR. Today, it's nearly 11%.
Wow.
And management stated on the call that they expected to hit 18% of their total ARR, which would be well over $600 million by the end of fiscal 2027.
The adoption is moving that fast because the return on investment is immediate. It's highly measurable.
Yeah, they had some great examples on the call.
Right. When you remove administrative friction at an enterprise scale, you aren't just saving an hour of time. You are fundamentally increasing the capacity of an entire department.
Let's talk about those real-world examples because they really illustrate the mechanics of this. Take Vestwell, a leading fintech company.
Right, the 75-minute process.
Exactly. Before adopting IAM, it took their team 75 minutes to create a new, complex customer agreement package. But by plugging IAM directly into their existing systems, they cut that 75-minute process down to just 5 minutes.
Which is a 93% reduction in time. Just wild.
Yeah.
And then you have Payworks, a developer of workforce management software. They integrated IAM workflows into a highly complex Salesforce implementation.
Okay, and what happened?
As a result, their 24-hour contract completion rates increased from 55% to 87%.
That's a huge jump.
It is. By getting contracts executed faster and with fewer manual errors, they actually recovered more than $400,000 in annual sales rep productivity.
But wait, if they're fundamentally changing what the software does, they also have to change how they charge for it, right?
Yes, they do.
In Q1, Docusign is rolling out consumption-based subscription pricing for IAM to their enterprise customers.
Which is a big shift.
Huge. And my question is, doesn't consumption pricing introduce massive revenue volatility? Like, if an enterprise client has a slow quarter and uses the AI tools less, Docusign makes less money.
That is a very fair concern.
It seems like a super risky way to manage a $3 billion recurring revenue base.
It would be risky if it were pure pay-as-you-go, like a water or electric utility bill.
Right.
But what they are actually implementing is a service credit model, which is honestly a brilliant strategy for driving enterprise adoption.
Oh, so.
Instead of forcing a massive enterprise to predict exactly how many AI summaries or identity verifications they'll need over the next 12 months, the enterprise simply buys a large pool of credits upfront.
Ah, so it's a sandbox approach.
Yes, exactly. In the past, you bought envelope capacity, meaning one credit equaled sending one document for signature.
Right. Very one-to-one.
But now, a credit is a unit of compute power. An enterprise can spend those credits dynamically.
Oh, that makes so much sense.
Yeah, maybe today they spend credits using AI to extract data from a vendor contract, and tomorrow they spend credits verifying a new employee's identity.
It's super flexible.
Very. And by lowering the barrier to entry, it encourages the client's internal teams to experiment with these AI tools.
And once they are hooked.
Exactly. Once the client builds these automated workflows into their daily operations, their usage naturally expands, and they end up purchasing much larger pools of credits upon renewal.
But that raises a pretty critical technical question for me.
Okay, what is it?
If I invest well and I am cutting a 75-minute contract generation process down to 5 minutes, that requires some heavy-duty artificial intelligence.
Oh, absolutely.
But if DocuSign is just pinging an external API like OpenAI's ChatGPT every single time a user processes a corporate contract, wouldn't their cloud computing costs absolutely obliterate their gross margins?
It would certainly eat into them.
I mean, AI compute is notoriously expensive.
It is, and that is exactly what would happen if they were relying entirely on massive, generalized public models. But this is where DocuSign's hidden architectural advantage comes into play.
Okay, tell me about this.
During the call, they highlighted a system called Navigator. Navigator is their intelligent agreement repository, and they have now ingested over 200 million consented private agreements into this system.
200 million.
Yes. That is up from 150 million just last December.
So they have a proprietary database of 200 million actual finalized corporate agreements to train their AI on.
Yes, and what's fascinating here is the mechanical advantage of that specific data. It is profound.
I can imagine.
When you train a massive public large language model on the open internet, you are forcing it to scrape everything from Wikipedia articles to, random Reddit threads.
Right, just to try and guess what a professional corporate liability clause looks like?
Exactly. But DocuSign's internal AI models are trained exclusively on a massive library of highly structured, finalized, customer-consented contracts.
That's a huge difference in data quality.
Huge. And because of this targeted training, their AI achieves up to a 15 percentage point improvement in precision and recall compared to models trained purely on public data.
Let's actually break down precision and recall mechanically, because those terms get thrown around a lot in AI, but the distinction is really vital in a legal context.
Please do.
So precision means that when the AI highlights a paragraph and labels it a liability clause, it is actually a liability clause, not a hallucination.
Right, it has to be accurate.
Yeah. And recall means the AI was thorough enough that it didn't miss the 3 other hidden liability clauses buried deep in the appendix of a 100-page document.
That is a perfect distinction. And a 15-point jump in both precision and recall is the difference between an AI tool that is, merely a helpful assistant and an AI tool that a corporate legal department can actually trust for compliance.
Okay, so to put an analogy to this, training an AI to negotiate a corporate contract using the public internet is like trying to learn how to bake a perfect souffle by reading random food blogs and restaurant reviews.
Right, you get a mess.
Yeah, you might get the general concept, but you are going to make catastrophic mistakes when it comes to the chemistry.
Definitely.
But DocuSign training its specialized AI on 200 million finalized corporate contracts, that is like handing that AI a Michelin star chef's private handwritten recipe book. The highly structured quality of the input data literally dictates the quality of the output.
That is spot on. And that highly structured data is actually the secret to answering your earlier question about computing costs.
Oh, right. The margins.
Yeah. Because Docusign's proprietary models know exactly what a contract looks like. They don't need to use massive, expensive, generalized models to do the heavy lifting.
They can just use smaller ones.
Exactly. They can use smaller, highly optimized models designed specifically for document parsing and data extraction.
Wow.
And by doing this, they have optimized their AI processing costs to be 50 times cheaper than if they were running direct prompts on public large language models.
Wait, 50 times cheaper?
50 times.
So that explains how they are maintaining that 33% free cash flow margin. They are insulating their gross margins from the skyrocketing costs of AI compute that are plaguing pretty much all the other software companies right now.
Precisely. And they are using that proprietary advantage really strategically.
How so?
Well, they aren't building a walled garden and forcing you to only use their interface. They know that enterprise employees work in dozens of different applications every day.
Right. Nobody wants to log into yet another portal.
Exactly. So they are integrating their trusted agreement data directly with major AI players.
Oh, smart. Who are they partnering with?
Well, they partnered with Anthropic, so you can use natural language prompts in Claude's cowork environment to securely review Docusign agreements.
That's huge.
It is. They also have integrations with OpenAI's ChatGPT, Google Gemini, and Salesforce's Agentforce.
Wow, they're everywhere.
Yeah, they are basically ensuring that Docusign's specialized contract intelligence is accessible from whatever dashboard the client prefers.
But having an incredibly precise, 50 times cheaper AI model is ultimately useless if enterprise chief financial officers and chief information officers are just, too afraid of the technology to actually deploy it at scale.
That is the big hurdle, yes.
So how are they convincing these massive, historically risk-averse companies to integrate this platform deeply into their IT architecture?
By proving that they can solve systemic data bottlenecks, not just speed up a signature.
Okay, give me an example.
The enterprise deals highlighted in the Q4 call are perfect examples of this architectural shift. Let's look at Aon, the massive global professional services and insurance firm.
Right, Aon, their entire business model is essentially built on assessing and managing risk through really complex agreements.
Exactly. And Aon is using IAM for a highly strategic initiative called the Meridian Project.
Meridian. Okay.
And the goal here isn't signature capture. The goal is data surfacing. Think about the sheer volume of data locked in old static PDFs, resulting from decades of insurance underwriting and corporate mergers.
It's got to be millions of pages.
Hundreds of millions. And Aon is using IAM to ingest all those legacy agreements. They are turning dead digital filing cabinets into an active, queryable intelligence asset.
That is wild.
Right. Now, their analysts can instantly assess total geographic risk exposure across decades of historical contracts, just like that.
And then you have the integration with the Bank of Queensland, which purchased Docusign through the Microsoft Azure Marketplace.
Yes, another great example.
This example really highlights the IT architecture change for me. Bank of Queensland isn't just adding a Docusign step at the end of a process. They are actually using IAM to power a completely new end-to-end customer onboarding workflow.
Exactly. Let's walk through that workflow.
Yeah, please.
A customer inputs their data. The IAM system uses an API to validate that data in real time. Then it performs identity verification, executes the legal agreement, and then, this is the crucial part, extracts the structured data from that agreement and writes it directly back into the bank's core Azure databases.
So no human is typing that data back in?
Nope, it completely eliminates manual data entry, drastically reduces the cost to serve a new customer, and tightens their regulatory compliance controls all at once.
I mean, it's not a PDF sitting on hard drive anymore. It's a continuous database update.
Precisely.
And that level of deep architectural integration explains why their fiscal 2027 guidance is so confident. They are projecting an 8.5% growth in annual recurring revenue, which will put them at roughly $3.55 billion.
It's a very strong projection.
Yeah. And despite the heavy capital required to fund an AI platform transition, they are guiding to maintain a 30% operating margin.
They can maintain that margin because they are drinking their own champagne, so to speak.
What do you mean?
Well, management noted on the call that 60% of Docusign's new internal code is currently AI-assisted.
Wow. 60%.
Yeah. They are capturing massive internal engineering efficiencies and intentionally reinvesting those savings back into research and development and a new top-down enterprise sales motion.
That makes perfect sense because if you are selling a platform that alters a bank's core IT architecture, you literally cannot sell that to a mid-level IT manager.
No, absolutely not.
You have to sell that vision directly to the C-suite.
Exactly. And if we connect this to the bigger picture, DocuSign is moving far beyond the endpoint of a transaction.
Right.
By introducing specific tailored product workflows like IAM for HR and IAM for procurement, they are actively embedding themselves as the central nervous system for how these entire enterprises operate from day to day.
Okay, let's bring all these threads together. We started this deep dive looking at a company famous for simple digital signatures that is now generating $1 billion in pure free cash flow.
An incredible leap.
Totally. We unpack the mechanics of their annual recurring revenue and their hyper-growth intelligent agreement management platform, which is, fundamentally changing how corporate data is extracted and utilized.
Right.
And we examined their proprietary 200 million document moat, which gives them a massive structural advantage in both AI precision and computing costs.
And for you, our listener, the primary takeaway is this. Looking closely at how contracts are evolving is an incredible analytical tool.
It really is.
Contracts dictate the flow of capital and liability. By understanding how AI is automating the creation, negotiation, and extraction of those contracts, you can see exactly where massive enterprise efficiencies are being gained and where traditional administrative bottlenecks are being permanently eliminated.
It really is a powerful lens for analyzing the modern economy. But before we wrap up, we always want to leave you with a larger, lingering question to ponder as you go about your week.
Right. Consider the broader trajectory of artificial intelligence. Right now, the massive public AI models are increasingly running out of high-quality, human-generated data on the open internet to train on.
Yeah, they've pretty much read the whole internet.
Exactly. They have already ingested the public forums, the articles, and the blogs. As that public well of training data inevitably runs dry, will companies sitting on massive proprietary silos of highly structured, consented private data, like DocuSign's library of 200 million finalized corporate contracts, become the most valuable technological commodities on Earth?
Wow. When the public internet isn't enough to make the model smarter, private data basically becomes the ultimate gold rush.
Exactly.
Well, thank you so much for joining us on this custom deep dive. Keep questioning the systems around you, keep exploring those invisible connections, and most importantly, keep learning.
See you next time.
Until next time, remember, when you look at a towering skyscraper of a business, don't just look at the glass and steel. Look at the invisible nervous system holding it all together.